Hi, everybody, and welcome to the webinar. I know our attendees are just getting put into the room. Thank you so much for attending. And we are so excited to do our second year of U of M benefits enrollment and how that integrates with your financial planning. This is such an important topic, and we have this discussion with so many clients given our location here in Washtenaw County. And so here we go. Let's get started and talk all about it. First of all, as we get started, I just want you to know that the University of Michigan benefits are fantastic, but they're also a lot. There's a lot to decide. And we know from a financial perspective that, or from a behavioral perspective, I should say, in terms of psychology, that sometimes when you have a lot going on, it becomes more difficult, more challenging, and more complex, even when there are good things to decide on. And so this time is really devoted to getting the highest and best use out of your decision making when it comes to your benefits as well as your open enrollment. So just so you know kind of who we are as we're thinking about this presentation and kind of talking about what we're going to be talking about today. We're going to go over some of the key benefits of University of Michigan's plan, where there's complexity and what you should be thinking about. We're going to be talking about retirement plans, even though those actually aren't part of your open enrollment. I just think it's the most important time to kind of catch your attention and put some eyes on that, as well as your health insurance and medical expense accounts, life, disability, and other expense plans, and how we can help. So again, my name is Melissa Joy. I'm a financial planner at Pearl Planning, and the team, I've included a picture of all of the CFPs, certified financial planners on our team. We are working day in, day out to help make better decisions on behalf of our clients or with our clients, not for them, but with them, and really educating them along the way. And like I said, so many of those clients, because of our location, are employees at University of Michigan. And so, and thus, we see these decisions time and again, not only what's on the open enrollment site, which is a lot and a really good information, but we're also seeing how they impact people's lives up to and through retirement. And so that's, really why we're bringing this information in. So let's break down kind of the most important University of Michigan benefits. And I know there are more, like we haven't focused on your vacation and time off and things like that. But we have health insurance, which now includes a new, as of last year, option for high deductible health savings accounts. There are also there's FSAs if you choose a lower deductible plan, but also supplements when it comes to vision and dental if you choose the higher deductible plans. You also have so much going on when it comes to your retirement plans. And then you have life insurance, and you have options to kind of up your life insurance beyond what is the basics, as well as long-term disability, which is a great benefit, legal services, and there's some more, but those are the ones that we really want to be focusing on. We're going to be going into some of the details on some of these, but just as we get started, I would tell you that it's great to do an audit or assessment of what you've got going on with your benefits, and this is the perfect time to do it. But as you know, if you're like many of our clients, you're either busy professionally, busy personally, or busy with family, so you've got a lot going on. And scheduling that time during a busy and hectic time of year, which, I mean, let's be frank, all times of year are very hectic, can be daunting. So I encourage you to schedule some time, put time aside mid-October to really review what's going on and what you have been doing and what you may want to change. In fact, as I was staying late at work to do this presentation, I got an email from a client who's a U of M employee saying, "Hey, do you think I should do dependent care? I'm just not quite sure because we have babysitters, but not nannies where we're withholding taxes, and I need to kind of figure that out." And so what we did is we looked through and talked about, well, how many summer camps are the kids going to? Because those count as well. And those are definitely, viable. And we looked at the tax benefit of the trade-offs of one versus another. You don't get a chance to do that if it's the 11th hour and you need to get your decisions made post haste right off the bat. Also, I would encourage you to coordinate with your spouse or partner if you have both have jobs and benefits. I know much of the time University of Michigan employees, if they're with a spouse who's not working at the university, will tend to carry the health insurance benefits, but you've also got a lot more capability of contributing to retirement plans than some people would have in the corporate side of things. And so that's something to keep in mind. So don't just schedule time for yourself, but schedule time to discuss with your partner if you guys are married and kind of joint benefits. And then, you may need to each do some of your own research and coordinate between the two kind of open enrollment seasons. Not everybody has an open enrollment right now. It's not a requirement to do it in the fall, but it just tends to be the pattern where the calendar year comes up. You need to get everything lined up before that calendar year. And so many businesses have the decisions at this point and time in the year. So what's new for 2025? Well, we have some additional benefits when it comes to life insurance, although they're not huge. Also, there's some additional options when it comes to the legal plans. And that's one area I'd like to focus on just briefly. I'm going to be talking about it on our next topic as well. But I see so many people at University of Michigan who choose to have the legal plan enrollment, and then they are sitting there without an estate plan. So they don't have a power of attorney, a healthcare power of attorney, will, and in some cases they may need a trust. People who may need a trust would include people with minor children, people with special needs, and trust can be a very elegant way to avoid probate. I'm not an estate planning attorney, but I definitely would encourage you to talk to one if you needed to understand, kind of the reasons that you might do estate planning, which is drafting those documents or updating those documents. But time and again, I see people, because it's a relatively low cost for the benefit, kind of checking that box and choosing to get the legal services, but then not following up on the proactive legal services that many, if not most or all of us need. And so I would encourage you to, if you're checking that box for the legal services and know you need estate planning, to really make the decision to put that on the calendar. And if you're sitting here and you have the legal services this year, don't know if you're going to be choosing them for next year, there's no time like the present to pull down that list of attorneys and then schedule a meeting to get your documents drafted. Why not just get it off of your list before you're making your New Year's resolutions? And I will tell you, it takes some time. And one of the drawbacks of those legal benefits is that the attorneys get paid less. And so there's always a shift in terms of who's, really doing those services. But there are some really great firms that participate in that in the Ann Arbor area, just knowing that the University of Michigan Legal Services Plan is available. So keep that in mind. What they've added to the list is family law as well. So for example, guardianship or divorce services. I would just take that with a grain of salt and make sure that you have good choices for those attorneys. I did have a client who was working at a firm that also had legal plans. It wasn't University of Michigan. They were looking for an attorney to do assist them with divorce through their legal services plan, and really had to make a lot of phone calls and perhaps ended up with a less than ideal option in terms of experience and kind of practice and expertise in the family law area. So you've really got to evaluate based on the service you need whether that attorney who's on that list is the best for you. Okay, so I really want to make sure that you have actionable information as a result and outcome of listening in on this. And I'm not going to keep you for 2 hours. I know the original kind of invite was like 6 to 8. Nope, we are going to get this done in about 30 minutes, but I really want you to be thinking of some ideas that might turn levers when it comes to your overall financial life. And here's my top 5 list of how to maximize the benefits that you have available at University of Michigan. So first of all, let's think about retirement. University of Michigan is terrific, and we're going to go over some of the details of why in a moment. But I hope that you have generous options and opportunities for retirement plan. For every 1% that you put into the plan for the first 5%, after you meet the eligibility requirements, you will get a 200% match. And now money's going into different plans, and there's a lot of complications there. But sometimes I think I hear people say that they are maxing their retirement when they've met that 5%. And certainly you're ahead of the game compared with many people who may get a match on the first 3% at 1-for-1. So, whereas a standard plan may have you get to that match and you would have 3% of yours and 3% of theirs adding up to 6%. If you're getting to that match, you're going to have 15% of your income going, similar to your salary, up to 330,000 going into the accounts. So that is terrific news. But what you may not realize, and for those super eager savers who I know are more likely to be listening to this webinar or the replay that we'll have available of it, is that you actually have options to save much more when it comes to University of Michigan retirement plans. One rule of thumb I have is that if all things being equal, you have relatively decent cash flow, a great way for you to be successful in terms of contributing and being ready for retirement is to make a bump up in terms of how much you're saving each year in terms of percentage. So if you start at that 5% where you aren't giving up the match, which is so valuable and generous, then can you nudge up 1 or 2% each year? So start at 5 and go up to 6, or up to 7. And then again, give yourself a reminder at this time of year. Hopefully you remember this advice year over year. And if you have room in terms of your budget and cash flow, do nudge that up. This is one of the best parts about being a University of Michigan employee. Sometimes highly educated employees of U of M end up having a ton of value in their home because homes in Ann Arbor are expensive, but also valuable, and then a ton in their retirement plans. And sometimes when we're talking about are you maximizing your benefits, you may even be putting too much in that retirement plan. I'll get to that in the pitfall area. But it's okay if you've been a super saver early, if you get to a point in time where things get more expensive in the rest of your life, to nudge back if you're on track for retirement. I know that's not everybody, and that's really where someone like me and my team at Pearl Planning can come in to tell you, you know what, you've got everything nailed for your late 50s and 60s, but we really need to make some adjustments for right now. Now, historically at Michigan, you've had very generous health insurance plans as well, where most of the costs were paid by U of M. And of course, as you know, many people who retire from the university as well have subsidized health care as well, or health insurance. And so now, probably because of cost saving efforts and kind of, just ways of the times, you have options, and you can also go into a high deductible health plan. We'll talk about this in a moment, but what that opens the door for is, perhaps more costs along the way, depending on your usage of medical insurance, but it opens the door for an additional savings vehicle, which I mentioned next. The FSA and HSA, the health savings account and flexible spending accounts, are both available. It just depends on, when it comes to healthcare at least, as to whether you are doing the traditional lower deductible plan or the newer higher deductible plan, as to which you would be eligible. The FSA is still eligible as a supplement for vision and dental at U of M, as well as for that dependent care. So that's a tax advantaged way for you to save for childcare expenses in many cases. But the health savings account, for those of you that are sitting on a little more cash and or might be able to pay for more of your medical costs, not all of them, but more of them, more deductibles out of pocket, can be a really great way to turn on an additional retirement account that is triple tax advantage. So if you're a geek financial planner like me and my team, we love the health savings account, especially if you're able to start investing that and thinking of it as long-term dollars. So that's a great way to maximize your benefit. Fourth, your life and disability. Um, it could be that you're maximize the way and the pathway for you to maximize or kind of do the best pathway for yourself would be to up the life insurance through the group medical plan. There is some portability with the University of Michigan plan, but one thing that is also worth considering if you're going to, you're tenured, you're a lifelong employee of U of M, is that in some cases, those life insurance policies tend to get more expensive every year because they reprice it based on your age every year. So in some cases, you may be underinsured by just relying on the plan. And in other cases, you might not need the life insurance, but you kept it on all autopilot all these years. You don't really notice how much it's starting to cost when it comes to your paychecks once a month. And so in that case, you may um, be overinsured and you may consider reducing that insurance. Certainly, a lot of people don't choose to take their life insurance into retirement because they've already pre-funded most of the costs that would be good. And so there could be some play or discussion about whether it would be better if you were to either reduce your insurance, your life insurance, and or change it to be a term policy where you can lock in the rates for the number of years that you think you may need that policy and or for a higher level of coverage than would typically be offered in the plans. And then, like I said, I also mentioned the legal services. Things to keep in mind there. One, make sure that you have a good fit when it comes to the attorneys that you retain with the legal services. And, in some cases, it may make sense to pay out of pocket, but in other cases, you should just use that benefit because you're paying for it anyway. So weigh the advantages and disadvantages. We've had University of Michigan employees that got great estate planning documents drafted that were everything that they needed. And we've had other employees that needed something a little more specific or complicated that chose to go the pathway of using different estate planning attorneys still here in Michigan, but those that may not need to participate in the legal services plan since there is a more restricted list in terms of your choices. And again, like I said, take it with a grain of sand too when you're going off the list. You may need a little bit more nuanced services, whether it's protecting intellectual property for an invention that you just had, or having someone help you with divorce or custody issues. It may or may not be right to use that legal services plan. And sometimes maximizing can be editing as well. Okay. Also, I want to kind of dig into one of the most complicated parts of University of Michigan benefits. And I sneak these into the open enrollment presentation each year because I think this is the perfect time to do a deep dive of everything that you've got going on. So, University of Michigan retirement plans can be adjusted almost any time of the year. You don't have to only do this during open enrollment. But like I said, we kind of think of the benefits that we get through work in chunks. I know with my husband's company, there's that time of year in October where he says we need to do our enrollment, and then we go over the details and things like that. And that's a great opportunity for me to go back in and look at the things that are coordinated since I'm the financial planner in the family. Okay, so you guys have the 401A basic retirement plan, as well as the 403B and 403B supplemental. I grouped them in together in the middle light purple column, as well as the 457 plan. And then you have an additional choice, which I think is, both a blessing and a curse. I like both institutions. We manage money both at TIA and Fidelity. We try to be agnostic. There's certain, kind of preferences depending on the type of client in terms of one versus another. And we can always talk through those with people in terms of, kind of the decisions that they're making. I see some people split it 50-50. So you've just got like, 4 different types of accounts at each login, and there's a lot going on there. But I would say, the 401A is receiving your match. And then the 403B is the 5% plus supplemental. There's more that you can give. I'll show you that on the next slide. And then you have that 457 as well. And there's more investment options. Each of them has, well, I should say each of your deferrals, the 403B choices, as well as the 457s, also has a Roth component as well. And I'll say a lot of people have opinions on Roths. I know when we're young, people are like, do the Roth, you should do that. I don't disagree, although I think there's more nuance. If you're, bringing in a ton of money and also things are tight and you're looking at your tax bill and saying, how am I making this much? And I'm not able to, bring home as much as I wanted, then that's a time where I would really look at not only where you think, whether you think taxes are going up with the next administration or over time, but also where tax brackets are for you working versus you retired. And that's a great example of where some professional advice may be appropriate, because kind of your uncle's rule of thumb when you graduated school, it says, make sure you contribute to a Roth IRA every year. Well, that rule of thumb becomes a little more nuanced, or a lot more nuanced, if you ask me, when you get closer to your peak accumulation years and you're really doing the financial adulting and getting real prepared for retirement. It's not always the case that you're going to be always paying more, and it could be better to have a pre-tax option. Okay, so we have all of these choices just to kind of lay it out in a different way. There's a lot of money that you can put into your retirement plans at University of Michigan. I'm not going to say that you have to do this. And also, I know most people, many, if not most people, are not maxing all of the options because it's a lot of money. But what I will tell you is if you have a spouse or partner who is also working, perhaps you're both, kind of, this is the slide for high earners, especially. If you're both working, there, you can slip some money in if you think of your money as, kind of marital and joint from them, kind of hitting maxes at a lower rate. You can slip some money in pre-tax into plans over here if you kind of think of your money as commingled. So the 401A match is capped out at 330,000 with 10%. And I should say these numbers, when you're listening to it, they change from year to year. So, this is targeted at 2025 anticipated rates, but they'll be different if you're listening to this recording in the future. Then you have your 403B plus a supplemental. That's where you'll put that 5% in. But also, if you're under age 50, you can put up to 23,000. And if you're over age 50, you can put up to 30,500. Now, this is a great time of year since we still have a few months and you guys have at least 2 paychecks if you're listening to this mid-October in a replay. Take a peek and see where you're at year to date. And if you feel like you have some extra cash, or else you also think you may have some tax liability depending on what's happened elsewhere, you could nudge up your retirement savings just through the end of the year to kind of help you out on taxes or do a little catch up when it comes to retirement. Keep that in mind. But I will say, if you kind of tally things up, the 457 doesn't count toward the caps when it comes to traditional retirement plans and IRS limits. So there's even more that you can put in because there's similar limits when it comes to the 457 plan. So you really have a lot of possibility to put a lot of money, up to 46,000 when it comes to employee contributions, plus you have the variables of the 10% match for the employer contribution. So really that's getting you close to $100,000. And that it can be really powerful, especially when you're turning on that pre-tax, or if you've just got all the cash in the world and you want to pay all your taxes now. If you put that into Roth, that's just a really powerful engine, whether it's for your use in retirement or for a legacy for the rest of your family. So, wow, what powerful things to remember. Now, there may be some important opportunities that you might be missing. And I'll say number one, and I should have this with a gold star in bold and like its own slide, is please review your beneficiary designations. Now, there's probably more beneficiary designations out there than you may realize. But first of all, I would mention when it comes to Fidelity and TIAA, we did an audit for all of our clients that allowed us to access their University of Michigan retirement plans this year. And we found a ton of, kind of surprises, I guess, or stale data when it came to beneficiary designations. I mean, that's one of the things that you have to check all the time. Who knows if there's a system change and they don't catch, kind of updates. Everything's electronic nowadays, so you're not going to be able to pull out a form and say, no, here it is. This is what it should have been. Please review and update your beneficiary designations, and keep in mind when you're in the system, I'll just pick on Fidelity, but it's the same at TIAA. If you're in the system and go into one account, one, type of account and say, this is the beneficiary designation, it doesn't automatically apply across the board. So you really have to be careful. Let's say you did grad school work at one institution and then you came to Michigan and you've been professionally employed here and you have accounts both, before you were married and after, at one's at Fidelity, one's at TIA, whatever it is. There's a bunch of different accounts that you may need to be checking. And I'll just tell you from anecdotal data that somebody listening to this recording is going to be looking and finding something that was a surprise. Things that we like to remind people of are that if you have minor children and you list your kids as beneficiaries directly, then something happens to you, that kid is going to be walking around with your retirement account and full control of it somewhere between ages 18 and 21. So keep in mind, this is a great use of a revocable living trust if you've got kids, and your beneficiary designations are going to matter because they don't just say, oops, that's a minor child, so we're going to need to like override what you put on there. It really matters. Other places where it's really important for you to double check any life insurance policy that you have, any annuity policy that you have. You can even add beneficiary designations, which are also known as transfer on death or payable on death designations, at your checking and savings accounts, your bank accounts, your investment accounts that are taxable brokerage accounts. All of these are possibilities. So do, just set aside that time, since we're kind of doing the reverse of a spring cleaning, we're doing a fall audit. Do make sure you're looking at your beneficiary designations. Also, if you have chosen that high deductible plan and you're contributing to the HSA, are you using all of the funds? Because if you're not, and let's say you have more than $1,000, or you've really intentionally set aside that money for longer term, you have the opportunity, it's not use it or lose it, you have the opportunity to invest it. And that can turn into a really powerful vehicle, because if you were to invest it today, you are able to take it out tax-free, just like a Roth IRA, as long as it's for medical expenses. And even if you need it for other expenses because you've got more medical covered due to the generous benefits of University of Michigan, first I'll just mention that that is typically not the case. People often find uses for medical expenses in retirement through their HSAs, but that can also double as retirement funds, and you get the same kind of tax deferred treatment that you would have for your 403B or 457. And so the chart on the right is just showing you, if you were to start doing contributions and also did catch up contributions to a health savings account, that can really create powerful earnings. In this case, they're assuming that you're in a 24% tax bracket and you get 7% returns, and potentially you do get tax deductions along the way. Just wow. So you potentially could have $40,000 in tax deductions if you started at age 50 and went through 65, as well as an ending balance of up to 290,000. This isn't a U of M specific example, so it doesn't assume, kind of the participation that the university has as well. But I think it's a great generic example of the power potentially of saving with HSAs. By the way, you need to check the beneficiary designation on your HSA as well, because those are also can be left, and you need that beneficiary designation in order to do it. The third thing I would mention in terms of missed opportunities is saving beyond that match. So don't assume that the match is the max. Do be thoughtful and try to boost your savings if you so need it, beyond there if possible. Also, if you feel like your taxes are pesky, but there's more cash sitting around, that's a great possibility. Also, don't miss creating your estate plan via legal services. I'll say it again because I just so often see people that are like, yeah, I know what's on my list. And then you look at the pay stub and you see, well, you're paying for it, so why not do it? And as I mentioned, evaluate appropriate life insurance policies. If you have some extra costs that you know you need to cover, let's say you're a second marriage and you want to make sure both your spouse and your kids from your first marriage perhaps are taken care of, or you have a mortgage that is larger and you want to make sure if something happened to you that your partner was able to continue to have the real estate. Life insurance is a great place to do it. While I say that, also don't get tied up into kind of a sales pitch zone when it comes to life insurance. We often, I won't say always, but often, really basic, simple term life insurance that is no bells and whistles and no big commissions to any agents is often the best kind of route to go for people. So, motivation for us is we love working with people. First of all, we love spreading the message beyond the scope of what we can do one-on-one, but we also encourage people to consider when is the best time to work with a financial planner. And I would kind of put things into three pillars, and wanted to give some examples of when we see that there may be a better fit to get more broad, comprehensive advice. So first of all, there's that DIY column. This is great for people who are just getting started, but they're dialed in. They're listening, they're going onto the website for the U of M benefits, and they're really, kind of locked in and not, ditching, really thinking, oh, I'll get around to saving for retirement when I get older. So if you're locked in, you can do great self-directed investing. You can make a lot of your own choices. There's a ton of information to educate yourself. And I think that's a great place to start. And for a lot of people, that's very appropriate. The second kind of column is there are definitely advisors that are available through a variety of pathways, but one would be through your custodian for your retirement plan. So your Fidelities, your TIAs of the world. If you're listening and you don't work at University of Michigan, there's other 401k providers, and often you get access to advice there. What I would mention there is that can be real strength often, and it's great. You're able to work with licensed professionals as well as sometimes certified financial planners. There's a lot of focus on the investments when it comes to those conversations, which I think are really important, but they're kind of table stakes when it comes to your broader, more comprehensive view. And so if you're looking for just, kind of account recommendations and management, that's a great place to start. They would also be happy to, open additional accounts for you, or you have other accounts and you might pay some for those, but traditionally you can get a call with anybody from the plans without extra costs. So that's like a moderate cost. When you get into a situation where you're preparing for retirement and you're talking to those people about like, hey, how's it work when I retire? And they're like, well, we'll write you a check when you need it. But you're not really seeing the consistency of like, well, which account does it make more sense to come out of? Because between me and my spouse, there's like 12 accounts to choose from. Or what are the tax consequences of this account versus that account? Or we have money piling up that's in cash now, and how do we invest in a tax aware manner outside of our retirement accounts? That's when a more comprehensive engagement where you can delegate to someone who's really helping you to be I like to say Luke Skywalker, and they're your Yoda on your shoulder, really talking in your ear, helping you to make better decisions. And if you're extraordinarily busy, also helping you to execute on those decisions in some cases. There's additional costs which could be paid depending on the firm, either as a retainer fee, a financial planning fee, which we do at Pearl Planning, or an investment advisory fee, which is often a percent of accounts. And so there would maybe more cost, but there may also be a little less chaos, a little more organization, and also more confidence in switching from an accumulation zone into a retirement zone or investing beyond your basic retirement accounts. Those are often cases that I see where it really makes sense to work with a planner. Also, if you tend to be a delegator and you're an expert in your field and you're looking for an expert in this field that you're not being paid to have expertise, that can be a great fit for the financial planner. And of course, if you're interested and curious about services like ours, or even want a list of firms like ours beyond that work with U of M employees, we'll be happy to provide that list or do an introductory call at no cost to talk about your circumstances. Here's a few case studies where we've worked with people with financial planning. I alluded to the first, which is I've saved a ton. I was always told that it's really important to save. And I'm the I being the client that comes to us. But now I'm sitting here and I've got competing interests. You know, we're a family of academics, or we have multiple degrees and we're saving for kids' college. We've got multiple kids we need to plan for. We also want to retire someday and we don't want to scrimp on that. But the credit card bills just keep piling up because life is expensive, and you don't just get expensive kids when they go off to school. They're expensive before that. That's a great case study and example where we actually, and you'll be shocked to hear this, but we told this family to actually ratchet down their savings so into the retirement plans in order to tackle the credit card debt, and then turn around and boost the savings after we'd gotten rid of that high interest debt, because we could show them that in 10 and 15 and 20 years, they were very well positioned for retirement, even with less savings. But the current and immediate needs were putting so much pressure and stress on the family, as well as just there wasn't enough money for current needs. But because they'd pre-saved and been so disciplined early, making that juggle really made sense. For another example is people that are motivated to retire early and they really want to know what retirement looks like, but they're not just going to lock into kind of, hey, I just want to, retire at 67 or 70 at my Social Security retirement age and then take a little supplement when it comes to my 403b savings. Instead, examples of people that have really focused on saving both in retirement plans as well as investment accounts. And there are nuances to the withdrawals when it comes to that type of thing. Or if it's before age 59 and a half, you need a strategy if you need to access your retirement funds that isn't going to get you a 10% penalty. And I'll tell you, there are several if you're a University of Michigan employee. So that's a great example where people are really looking to get organized and like see the proof in the pudding, and not just be, see a calculator on a website that doesn't really know them that says, yeah, you can retire and you can get $12,000 a month. They really need to see the specifics of a complex circumstance so that they can have trust in kind of making a game plan for an earlier retirement. A third example is coordinating with a spouse's high income job. Perhaps the spouse is self-employed. You have this great University of Michigan plan that has more retirement planning opportunities. And there's just a lot going on to coordinate in a high net worth circumstance. So many successful families can use someone to delegate and help, and also identify opportunities because they're well educated, but they're just not sure which thing they hear about, whether it's from friends or research on the internet, is something that they should utilize. All of these are great examples of where kind of converting from just the call center or DIY to a more sophisticated engagement creates results and also diminishes stress when it comes to like Am I doing okay? I'm just not sure. So many times I think the job of a financial planner is to tell people where they're doing a great job and then make a list and prioritize it of where they need to, where it might make sense to do things a little bit differently. But the atta girls and atta boys are just as important. So, as in terms of next steps, this isn't just a sales pitch. I want you to do a few things, and the first few things are all about you. One, set aside family time to choose your benefits, and you may need to make a couple appointments or coordinate with, the other enrollment decisions that are happening in the family. Whose insurance should the kids be on? How much are you saving, honey? And have you done anything about this or that? There's so many great things that you can really think about, and do a little housekeeping while you're at it. Do check those beneficiary designations. If you have accounts all over the place at former employers, talk about whether you should kind of consolidate things so that there's not so much going on everywhere. Because I can assure you that, like, diversification by location, where you have to have 45 logins, often results in kind of lapsed or misbehavior, because you forget about things like investing the account money that you put in back at 3 employers ago. And also put next steps on the calendar. This is a great time to give yourself reminders. So if you don't want to boost your retirement savings now, but it would be great to do it when you have a salary adjustment in January, put that in your electronic or paper calendar, whichever you prefer, so that you already have a place to, a go-to and a game plan. Now, a couple other just selfish asks. Do subscribe to the Pearl Planning newsletter, because we have webinars, videos, and things like this coming out all the time. And all you need to do that is go to our website at pearlplan.com and go to the newsletter tab to subscribe. And then if you do need help or would like to inquire about our services, please reach out. I want to open it up to Q&A. So if anybody has any questions, feel free to put that in the chat. And while I'm mentioning it, I will also say that we have a replay of this webinar plus a benefits roadmap, like a guide to making smart choices, available on our website. So if you want to get the guide, just go to the U of M benefits page, and we'll be happy to provide a PDF that kind of has a worksheet where you can really nail down what you need to do. Any questions? I'm going to keep it open, and I'm going to come back to this page, because the other things that I need to mention is how to contact us, of course, and don't hesitate to follow us on social. If you go to, for example, my LinkedIn page or Pearl Planning LinkedIn, we have a lot of this content, webinars. We're going to have a pre and post election economic update, because so many people are concerned about kind of what's going on in the markets. And replays of those will be available on social media and the website. We also have devoted a lot of time on our weekly podcast, Women's Money Wisdom, to open enrollment and benefit decisions. One great example is that we have an episode all about health savings accounts. So we didn't go into that exclusively today, but I want to make sure that you're aware that that's available. And in order to find that, look for Women's Money Wisdom wherever you like to listen to podcasts, or you can find that on our website as well. Okay, we have a few more disclosures, and then I'll go back and just make sure we don't have any questions. Let me look. I think we're good, but I am just going to look in the Q&A. Yep, we are all good in terms of the questions, but please do not hesitate to reach out, because we always love to answer your specific questions. And we just appreciate you attending and also listening to the replay. Thanks so much.